The stock market is one of the greatest wealth building tools in history, but the uncomfortable truth is that most stocks are actually terrible investments. Let's take a look at the data so you know exactly the risks of picking individual stocks. The stock market is great. We love it. It goes up over time. But the interesting part is that individual stock risk is very real and often ignored by folks, especially when we are in these big bull markets that we have seen recently. When you buy a single stock, it's very important to remember that you are not buying the market. You are buying an individual company that has a CEO, has a board of directors that can go make a dumb decision. It has direct competitors that can put it out of business. It's subject to any type of government laws that might come out in the next few years with a certain administration. There's a number of different factors out there that are very specific to individual stocks that you don't have when you buy the overall market. And the scary part is that the data shows a lot of this is true. In a study done by JP Morgan from 1980 to 2020 of the Russell 3000, 40% of stocks in the study experienced a 70% plus decline and never recovered from it. Of the stocks in that study and over that time frame, 42% of them had negative absolute returns. Yes, you heard that right. Just under 50% of all stocks in the study over that 40-year period actually returned negative. So that should give you an idea of just how risky picking individual stocks can be. And on that note, if you look at stocks which actually generated the return, the winners generated an enormous amount of excess returns when compared to the median stock, because the median stock actually ended up underperforming the Russell 3000 index over the same time period that the study was done. Let that sink in. The median stock significantly underperformed the overall index. So that means you are statistically more likely to pick an underperformer versus one that is going to significantly outperform the market. And expanding on this a little bit more is actually where it gets even more wild, is that a very small percentage of overall stocks over the last few years has actually accounted for a significant amount of the market gains. In 2018, there was a study published titled "Do Stocks Outperform Treasury Bills?" that analyzed stocks from 1926 to 2017 and analyzed over 30,000 US stocks. In this study, it was found only 42% of stocks beat 1 month Treasury bills over their lifetime. This means that more than half of the time, you are better off holding risk-free T-bills than picking individual stocks. Of the 30,000 companies analyzed, over 15,000 of them, or 51.6% to be exact, actually had a negative lifetime return. So while that's shocking, here's the most important line. Just 4% of the best performing stocks accounted for the entire net wealth creation of the US stock market over the last century or 100 years. The remaining 96% collectively only match Treasury bill returns. So a tiny minority of stocks explain nearly all long-term wealth creation of the market. Overall, I think this study is even better than the JP Morgan one just because it has 30,000 stocks in it. And the study tells you that, hey, half of these had negative lifetime returns. And of the ones that had positive returns, when you consider all of the ones that were included in the study, only 4% of them actually accounted for the majority of gains that we have seen in the market over the long term. So it just highlights how few companies actually do extremely well and drive most of the market performance that we have seen. Even when you dive into the S&P 500, this is a great chart that I like that shows only about 240 companies outperform the index annually. So there's 500 companies that are in the S&P 500, and at the end of the day, you're basically coming to a coin flip on which of ones inside that index are going to outperform and which ones are going to underperform. So even among the 500 largest companies in America on any given year, half of them are going to underperform the overall index. And that is before we actually consider the long-term survivability of companies actually inside the index, which is what this next study looks at right here. If you look at the data of companies removed from the S&P 500, this number continues to rise and rise and rise. Companies fail, they shrink, and they disappear. Nokia, BlackBerry, all these companies that were once big, they're too big to fail, nothing's ever going to knock them off, have now been knocked off by, let's say, Apple and Netflix. Yes, these are two drastic examples, but this just goes to show the evolution of the market, and even companies that seem like they are powerhouses today can be put out of business in the future. If you own the index, these losers are quietly getting purged and removed, and the new companies, the winners that have a great potential to grow long term, are getting added and you are automatically getting exposure to those companies. If you pick individual stocks, it's up to you to cut the winners before they die and up to you to add the winners before they really grow into these powerhouses that we know today. There's no automatic purge like there is with an index fund. And there's also the argument that I'll just pick the winners. The pros do it, right? Well, not quite. Professional managers have tried this too, and if you look at a study done by SPIVA, the data shows over the last 15 to 20 years, roughly 90% of actively managed funds underperform their benchmark. That means only about 1 in 10 professionals beat the market long term. And just because an analyst slaps a buy rating on a stock does not mean that you should rush out there and buy it. If you look at this chart posted by JPM, it shows that many strong buy picks actually see a massive decline. These are full-time analysts with entire research teams that have access to the best tools out there, and they still struggle to consistently outperform the index. All that said, it really makes me think and be honest with myself of what are my odds of consistently outperforming the market long term by picking individual stocks. Likely pretty low. And that's just something to keep in mind when you're building your investing strategy. It's something that I keep in mind, and just to know the odds are likely not in your favor. So should you never buy individual stocks again? No. It means just to understand the game that you're playing. Stocks have a high amount of risk and a high amount of volatility. If you want to pick individual stocks, you just need to be very aware of how much you're actually allocating to doing that. You need to know that those stocks can go to zero, and you need to be very honest with yourself as not to confuse your stock picking ability with the overall market returns. Because if the market is going up over the last 10 years and you've been great at stock picking, it might be a little bit of a coincidence. I'm just saying. But anyways, a lot of people look like geniuses in a bull market, and when things turn, a lot of people can get hurt. So just keep that in mind if you're going to have a high allocation to individual stocks. Overall, long term, the market is a compounding machine, but most stocks statistically are not. So that's the video. Thank you for watching. If you found this video helpful, you can check this one out. This is how I reached $100,000 invested, to talk more about my specific investing strategy in that video. Or if you're more curious about the actual returns of the S&P 500 long term, you can check this video out here. Thank you for watching. Hit the subscribe button, and I will see you in the next one.